Hey everyone, Austin over at Oxford Retirement again, coming to you with another educational video. This time we're going to be talking about the tax types of different accounts. Okay, so three here we're focusing on after tax taxable money. Okay, so this particular category has a lot of jargon attached to it. The main thing here is that it's just not a retirement account. That's probably the easiest way to think about it. But if you hear the term non-qualified, or taxable account or investment account, taxable investment account, brokerage account. Those are typically synonymous with this type of money. It's after tax money. It's like money in your bank account. Okay. That's the easiest way to remember it. Okay. So let's walk through the scenario again with that type of money. Okay. So here's our $10,000 again. We're going to make that as income. We're going to pay 25% taxes because you pay income taxes when you receive it. And then you're left with $7,500. And you decide you want to go invest that. Okay. Maybe you're not eligible for a retirement account. Maybe you're over the limits. Maybe you just don't have anything that you can contribute that to that's tax benefited, tax advantaged. So you go and just take that money and open up one of those types of accounts that I was talking about. Again, it could be called all sorts of things, but a non-retirement investment account. Okay, you throw the money in there and you can go invest. And let's say it also makes 6%. And therefore you got $79.50 in the account. The difference here is that you already paid the tax when you put the money in the account. However, when it grows, now you've got what's called phantom income. Okay, when there are dividends paid out from stocks or interest paid out from bonds, money markets, or just savings accounts rates, even a savings account at the bank. Okay, even if you don't take money out of that account, if it hits that account, you have to pay tax on it in that year. So you end up with a 1099 at the end of the year, whether you took the money out or not, because of what happened in that account, and it's going to create some income on your tax return. That's money that you're going to have to pay tax on the gains, interest, and dividends. So in here, I just have a 15% rate because maybe let's just say it's a long-term capital gain or a qualified dividend that gets the better rate. So you get a little bit of a discount from the 25% spot I put up here, but you still pay $68 in taxes on the growth. And now what you're left with when you walk away from the table is $78.83. Okay, so you can see why you would want to invest in a retirement account to try to capture the better end result, right? But you have to have some of this money, whether we like it or not. This is what you pay your bills with. This is what's in your checking account. This is what's in your savings account. Okay, this should be your emergency fund as well. So we have to have some of that money to operate. It's just not the most tax efficient way to invest. Okay, there are other ways to invest a little bit more tax efficiently. On the bottom here, you can see our three columns again, and it's non-deferred. I'm not going to go into the deferred in these videos. It's a little bit, it's just a little strange, so harder to explain. And most people don't have that anyway. But taxable non-deferred means that you are putting the money in the account. Do you get a tax deduction for putting it in a regular investment account? Absolutely not. Nobody's going to give you a tax benefit for that. Phantom income taxes, yes, you have to deal with those in that type of account. Dividends, interest, and capital gains on the account gets reported every year, and you pay tax on it as you go. Tax-free withdrawals, it depends. Okay, so and the reason it depends is when I sell out of what I'm invested in, do I have to pay more taxes because of that? Let's say I've held Apple stock. I bought it at $1 and now it's worth $100. I haven't paid tax on that yet because I haven't sold it. But as soon as I sell it, now I get to pay tax on the $99 difference. Okay, whether that be short-term or long-term rates, you got to pay tax on it. So if that's the case and you've got some big gains, well, that I wouldn't really consider that a tax-free withdrawals because you have all this built up gains. Okay, doesn't always happen. A lot of the times you're paying as you go, and you're selling this and buying that, so you're paying a little bit along the way. But if you let it ride and you build up this big capital gain, eventually when you sell it, if you sell it, then you get to pay tax on it. One little tax bonus tip is if you pass on that highly appreciated stock to the next generation or to your spouse, they can inherit it and potentially sell it with no tax. There's rules on that. I won't go into it here, but that can be a huge benefit, just passing that on to the next generation or to your spouse in some cases. So those are the three tax things. And last little bonus I'm going to give you is the HSA. I have it on here because I like talking about the HSA. It's a strange account basically because you get all three tax benefits down here. You can see how it's all green, right? So when you put money in, you get a tax deduction. You don't have to pay phantom income taxes if it grows while it's in the account. And as long as you use it for medical expenses, you get tax-free withdrawals. So that is the only account that does that. So I love taking advantage of it. I've got a 2-year-old, a 3-year-old. There's always plenty of medical stuff to pay for to justify the withdrawal. So I put money in every year. We take it right back out to fund things. So to fund everything that's going on, there's always expenses. So thanks for joining me. We'll see you next time.